Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bond investors. I'm Dan Barnes. US Treasuries are trading in the range of 2.2 to 2.9% at the moment, depending on their tenor, making them one of the few government bond markets offering a positive return. Trading these treasuries has changed dramatically over the past 10 years, challenging buy-side traders to deliver best execution for investors. We're talking with Tim Cook, Head of Sales for APAC and EMEA at trading venue LiquidityEdge, to analyse how traders can better seize investment opportunities for investors. Tim, welcome to Trader TV.
Thank you.
What are the risks that a buy-side trader is exposed to when trading US Treasuries?
When trading US Treasuries, the buy side has a couple of different factors mostly that they have to consider. One of those is the immediacy of the trade. So in the traditional formats, an execution trader on the buy side will be submitting either an RFQ or they'll be speaking to their dealer with whom they have a relationship. And that whole process takes time. And so from the point perhaps of their interest in making the trade to actually executing the trade, there could be a fair amount of market slippage. That price can be moving around. The other aspect which they are beholden to the market is market impact. Traditionally, a execution trader would state to maybe a handful of participants via RFQ, well, this is the instrument I'm interested in, this is the size I want a price back in, and perhaps this is my direction. And with that, there is market impact that has been leaked into the market.
How do you help traders manage those risks?
Yeah, we make traders manage those risks really by providing what is essentially a streamed order book.
Okay.
So we take the traders, we say, right, which liquidity providers do you want to be plugged into? And we will connect them to a range of different dealers. In their order book, they are then seeing a whole list of executable price levels where they could sweep across multiple price providers. Yep. They can still maintain that relationship with the dealer because essentially the dealer they are trading with has done their best to win the trade and they've won that trade on best price. So it really does make everyone a lot more accountable in this process. The dealer-to-dealer market really is made up mostly of on-the-run treasuries. Right. The dealer-to-customer market is made up of, let's say, 60 to 70% off-the-run treasuries. The on-the-run markets, they operate as a very liquid rate product. Almost in a currency in that sense. You have 6 issues which are very highly liquid, and everything is very commoditized and homogenized around those 6 issues. With the off-the-runs, you have a tail of perhaps 300 securities. Right. Some of those, perhaps the second to third off-the-run, the second to third series, or let's say the first to third off-the-run series, trade at a very narrow spread to where the on-the-runs trade. But the rest of that tail, and going out the other 200 plus securities, they are by essence quite liquid, and the price discovery isn't there as much as it is as those newer series. And really what we try to do on our platform is to look at what are the most liquid parts of that market, and that's where we see really the expansion of what's happening in the dealer-to-dealer space, moving over to the dealer-to-customer space as well.
So is there a risk then that without that there's a sort of cliff edge of information in terms of going from on the run to off the run, and you're sort of turning that more into a gradient?
Yeah, absolutely, and I think that's a well put point. I mean, yeah, you find that the majority of the information is around the dealer market, and and it definitely tails off somewhat especially towards the deeper end of the off the run. So yeah, I think what you're finding is there's a lot more transparency. And there's a lot more comfortableness in being able to quote at a tight spread in certainly the newer off-the-run series.
So sell-side firms are streaming prices to buy-side counterparties upon which they can execute. How do you see buy-side execution styles changing as a result of that?
Yeah, it's interesting. We've definitely seen a shift in the way that the buy-side firms will execute now. Maybe a few years ago, it would have been the tier 1, the tier 2 firms who were looking at kind of automated smart order routing and the ability for them to auto-execute via their own internal systems. And I think we've seen a proliferation of that and an extension of that to a wider demographic of buy-side participants. So typically, or historically, let's say,
Yep.
the traders or the firm would take the screen and they would look at the screen and point and click, there go, trade executed. The way it can be now is that essentially we will aggregate the liquidity and we could push that into a buy-side firm who has an algorithmic strategy that is working execution orders from the traders behind them. But also what is compounding and making that even more interesting is that the ability for firms to leave resting orders as well.
Okay.
And when you start to leave resting orders and you can layer on top some VWAP, some TWAP, and perhaps some other algos that are more firm bespoke, it then becomes very interesting. So the development has almost been, certainly at the let's say the sharper end, has been the fact that their they will take our liquidity, our packaged liquidity, and then they will plug that into their own execution capabilities, where it perhaps is a computer or a black box that is generating the execution.
Yep.
And it's really working behind the parameters that they define, not necessarily that of a manual trader sitting at a desk.
And of course, treasuries are used in two ways. You can use them for generating alpha and also as a hedge for credit
Yes.
as well. Does that affect the way that people need to interact with the platform?
A lot of those guys, they will hedge with the 10-year on their own treasury or the first old 30-year.
Yeah.
And that's certainly something that we are looking to foster broader partnerships with, i.e. the ability to get those credit trading guys actually access to real-time liquidity. One of the key things is the control of the amount of information that is going out on both sides.
And so there's transparency around greater information, but not transparency in the sense that it creates more risk for
Correct.
the trader.
Yeah, exactly.
Tim, thank you very much.
Pleasure. Thank you.
I'd like to thank Tim Cook of LiquidityEdge for his insights into the US Treasuries market, and of course, you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.